Hello, my name is Mark Orr, and I've been helping people improve their financial health and truly accelerate their reaching their financial goals since 1997. I've been a practicing certified financial planner and a registered investment advisor for over 10 years, and today I'd like to introduce you to a powerful financial tool that can help you meet many of your financial goals. Equity Indexed Universal Life Insurance is the newest and fastest growing type of universal life. Also known as EIUL, once consumers hear about all of its many advantages over traditional permanent insurance, or even the buy term and invest the difference philosophy, they quickly become interested in learning more. So let's talk about this exciting financial tool. EIULs have all the same qualities and advantages as traditional universal life. Like all UL policies, it offers safety, liquidity, and good potential returns, as well as favorable tax benefits. It can cover 1 or 2 lives, and the premium payments can be very flexible. Again, money can usually be taken out of the policy through withdrawals or loans on a tax-free basis to provide for emergencies or provide tax-free retirement income. Anyway, the difference in the major appeal of an equity index life insurance policy is how interest is calculated and credited to your policy. Now, there are various forms and slight differences between how certain EIUL policies work, but most work in the following or a similar way. The interest credited to your policy is tied to an equity index, usually the S&P 500, but sometimes another well-known market index is used. For our purposes here, I'll just talk about the S&P 500 index, as this is the one most commonly used because it is an index of the 500 largest US-based publicly traded companies. Now let's be clear. Even though the interest credited to your policy is tied to how well the S&P 500 index performs, your money is never actually invested in the stock market. What happens is that your money is invested by the insurance company in their general account, which is primarily bonds. These bonds and other investments pay an interest rate, and the insurance company uses part of that interest to buy 1-year call options on the S&P 500 index. Now, if you buy a call option on the S&P 500, the absolute worst thing that can happen is that the option expires worthless should the index be lower a year from now. So when the S&P 500 went down by some 37% in 2008, the call options just expired worthless, and the principal in your policy did not go down one little bit, since your cash was not actually invested in the index. And when the index goes up in any year, the option becomes more valuable and is sold for a profit, and a percentage of that gain is credited to your account. Now, most equity index life policies have a floor and a ceiling called a cap on the maximum interest rate your policy will be credited with, depending on how well the S&P 500 does. The floor, or the worst case scenario, is usually between 0 and 2%, and that's the least amount your policy will be credited with in any one year, depending on the policy you choose. In years like 2008, where there was a big drop in the S&P 500, my insurance clients proudly tell me that 0 was their hero. In other words, a 0 return is many times better than a 37% loss. Of course, the 2% return in some policies was even better than 0 in 2008. But regardless, the main thing to understand is that your account value can never decrease based on what happens in the stock market. Your account value cannot go backwards because the stock market goes down. Your 401k can't say that. In years where the S&P 500 does well, your policy will be credited by an interest rate that is subject to a ceiling or a cap, which is usually between 11 and 15% a year in most policies. So when the actual S&P 500 index goes up by 21%, the interest rate credited to your account will be limited by the cap in your policy, perhaps 14%. But most people I know are extremely happy and can sleep well at night, knowing their policy can never lose money when the market goes down, and yet they can enjoy up to double-digit gains in years when the market goes up. And unlike in the S&P 500 index, your annual gains are always locked in and can never be lost by future market losses. This is huge. Those annual gains become principal and are never at risk, nor can they ever be lost when the market goes down again, which it always does. The other important point to understand about these types of policies is the reset mechanism. To explain this, let's compare an equity policy to a S&P 500 mutual fund. Let's say that you had $100,000 in an equity index policy at the start of the year. The S&P was at 940. Over the course of the next 365 days, the index goes down to 650, declining about 30%, which is less than a decline than in 2008. If your policy is credited the floor of 2%, your policy account would now be worth $102,000, even though the market went down by a lot. However, if you had your money in an S&P 500 mutual fund, your account would be worth only about $70,000 after the 30% decline. But here's how the annual reset works, and this is an extremely important point to understand. For the next year, the base of which your policy index policy gain will be calculated is where it ended up the year before. So in this example, it would be 650. So if the market gained 20% from 650 going to 780, your policy would now have an account value of over $116,000 with a 14% cap. Meanwhile, if you had invested in the S&P 500 mutual fund, your $70,000 would now only be worth $84,000 with the full 20% gain that year. That's a positive difference of $32,000 in just 2 years with the equity index policy. That's the power of the reset mechanism that works in your favor when the market recovers from big drops, while mutual fund investors are just hoping to get back to where they were before the market fell. Let me make an analogy here. The way interest is calculated and credited to your equity index life policy is kind of like how many people would dream to gamble in Las Vegas. Would you play the game if when you lost your hand, the worst thing the dealer did was to give you your full bet back without a loss? And when you beat the dealer's hand, your gain would be limited to, say, 14% of your bet, and that 14% would be locked in and could never be lost in future hands? If you knew your principal was never at risk, would you play that game all day long? Most people would love to play that game. I certainly would. Of course, you can get the same protection from loss of principal if you invest in CDs and fixed annuities, but you generally do not get the potential of earning 12 to 15% in some years, nor are those gains tax deferred or potentially tax free, as I'll talk about on another video. In the seminars and webinars that I give to potential clients, I have a slide that shows the power of eliminating losses from your investing to show how superior an EIUL can be over just investing in an S&P mutual fund. If you had $1 million invested in the S&P 500 on January 1st, 2000, and you took the actual historical annual returns of that index, excluding dividends, your account would only be worth $589,737 on December 31st, 2008. That's a 41% loss in 9 years. Even with the partial rebound in 2009, those 10 years were still a lost decade with no investment growth at all in your mutual fund. However, if you were a 45-year-old healthy male that had the same $1 million on January 2008, sitting in an equity index policy, which in this case had a death benefit of over $3.3 million, your account value, even after deducting all of the policy insurance costs, fees, and charges, the cash value in your policy will have grown to $1,164,911 by the end of December 2008. That's a difference of over $574,000 in favor of the life insurance. And that only assumes the insurance policy had a 0% floor and a cap of only 12%. If the floor were, say, 2% and the cap was 14%, that difference would be substantially greater. And the future performance of the stock market can never take away those gains, since they are locked in. That's powerful and can help you sleep well at night. And remember that if that person died during that period, their beneficiary will get a $3.3 million income tax-free death benefit. That's another advantage of the life insurance. Don't have $1 million? That's okay. Any amount in the equity index policy over the years 2000 to 2009 would have had a similar result. The amount in the insurance policy would be almost double than what the market actually did, because your account can never lose money in the down years based on performance. In fact, in virtually every single 15-year investment period going back to the Depression years to 2009, a policy with a 2% floor and a 14% cap would have substantially beat the raw S&P 500 index that had no limits on its losses nor caps on its gains, which is the way most of you invest in the market today. So to sum up, because of the way the Equity Universal Life policy can't go backwards in value, locks in your gains forever, and uses the reset mechanism, it can be a great place to build your cash and do so with safety and liquidity. I understand that this is a new concept for you, so you might find it worthwhile to watch this video again. If you would like to speak with me personally on how these safe, flexible, and attractive contracts might give you the retirement lifestyle that you are dreaming about, then contact me today and we can discuss your goals and how best to get you there. I look forward to speaking with you soon.